Hi, welcome back. This is Paul Chan from DLBS. Let's begin our next video together. Welcome to video 12. Today we'll show you one more tool to add to your portfolio of different strategies. This one is called the caller. Let's get started. Here's the agenda we have planned for you today. We'll explain what exactly are callers. Compare the callers to something you've already learned in a prior video called the covered call. We'll also talk about what is a reverse caller, give you an example of XIU stock, and demonstrate how to use options play with your caller strategy, summary of the free tools, and a quick word on our mentorship programs. So let's get started. So covered calls, if you recall from prior video, callers are very similar, both of which you determine the strike price, you control the expiration dates, and whatever you sell, the premiums you collect right up front. And in both of these scenarios, you need to own the shares. So 100 shares for every contract sold. So quick recap of the covered call. If you have a stock where you're somewhat bullish, and let's say it's trading at $40 today. So long term, you're still bullish. That's why you bought the stock. And you would be selling a little bit out of the money. So let's say $42.50 is the strike price with a 3-month expiration, and you collect $2.50 in premium. So you're really trading your stock like a real estate asset. You're renting it out. So this out of the money generates income, and we can use options play to help calculate the probability of expiring worthless back in video 5. And again, any premiums we sell, we collect on day 1, and it basically adds to your income above and beyond the dividends you collect if the stock pays such, as well as any capital gains that you're hoping to capture by the long-term bullish trends that you forecast. And if you understand this, then we'll just add one more element to this. This is called the caller. So same example, same stock trading at $40. You're long-term bullish, but you're a little bit concerned about maybe general market downturns, maybe market crashes. So you are still selling your 3-month call at this out of the money $42.50. You collect $2.50 in premium. And we are going to buy a 3-month put option at a lower price, the $37.50 strike price. So that acts as a bottom of how far the stock could drop, and you're still protected. And for our example purposes, we will show $2.50 in premium spent on that. It may vary, it may be a little bit higher, it could be even lower. So again, you're treating your stock like real estate. You're selling an out-of-the-money call option to generate modest income, of which you will be able to use options play to help calculate the probabilities of expiring worthless. Again, the premium you collect from day 1, and you will use it to help pay for the put option that you're purchasing. So the caller is basically the covered call with a purchase of a put option to protect you as insurance. So now you're collecting rent and using rent to buy insurance. And the net effect of all this is the maximum profit you can take in is the $2.50 premium for the covered call sold. And the maximum loss you can incur is the difference between the stock price and the put price that you purchased. That's the insurance. So again, the option sold, the call out of the money helps pay for your out of the money put option purchased. There's also something called a reverse caller. And this is a scenario where, let's use XYZ again at $40. You do not own this stock actually. And you basically short the stock. You're somewhat long-term bullish. So you will buy a 3-month call option. And let's say it's $42.50 at the strike price. And it costs you $2.50. Of which then you will sell a put option. So this is a naked put. And let's use an example of $37.50 as a strike price, and let's assume $2.50 is the income there. So one pays for the other. And again, this example shows a 1-to-1 ratio. Depending on the market and the strike prices, you could collect more or you could collect less, but the idea and concept is the same. So It's a mirror image of the collar strategy. We're shorting the underlying security. We're selling outer money put option to generate the income, so it's just the exact reverse. Premiums are still collected from day one, and you're using the proceeds to buy out of the money call option. And here's basically showing the put option, like capturing the 250 in profit and protecting you on the other side as a hedge. So put option sold generates income, and a call option purchase hedges the upside risk associated with shorting the stock. So let's look at options play again. We have the scanners on the left with the bearish, of which we can sort into the scores, and then the bullish today we only have one, so we'll use this one, Northwest Company, as our example. And in news feeds you will see the updated news for this particular company, and in the charts as usual you have the prices at the top. I've preloaded it with RSI at the bottom. But under the studies button, we have numerous other indicators to help add to your visual presentation. And I can select whether I'm bearish or I'm bullish. And the circle on the right allows me to select a sub menu here hidden away. And under bullish, I can find long collar. And you'll see of the three panels, the left hand side is where we see the collar strategy, and I'll just go with the default. And the left button allows me to toggle and compare what if the price of the stock varies, and you'll notice we're capped at $35 in profit in this case. And I can also vary the dates, and this tells me my pair of profits depending on how soon or late it gets to that particular price. And as I make my trade, this is what we do. We buy to open a put option, we sell to open the call to pay for it, and we buy the security. And a quick word on the 5 colors you see there. We have stock trends, which is the market condition as well. Below there we have the options play score, earnings date, which is a reminder that there may be earnings coming up. And then a green for the spread shows there's liquidity and a nice healthy bid-ask spread. So typically if you can find 5 green dots, you're in wonderful territory. So there's the demo, and here's a quick word again of Canadian equities, why we keep showing you examples from there. Our Toronto Stock Exchange, wonderful diversification from the US dollar. It's a safe political climate, stable economy. It's got the best bid-ask spreads for Canadian listed stocks compared to the counterparts in the New York. And many famous companies that you may have heard of around the world. And by now you should be very familiar with all the free tools we've shown you in all the 12 videos that we've prepared. And I invite you to try out options play. In fact, for Canadian equities, the link at the bottom here, you can get your license for free. And for American equities, please try it for 1 month from either of these links. And I appreciate you taking the time to learn this. Keep learning. We'll be adding more videos as we go. It's a journey that never ends. Learn, practice, repeat. Use the virtual accounts that we show you. And if you like what you see, please tell your friends about us. Subscribe to our list on our website to get updates and trade ideas. And try our mentoring services in our marketplace. Welcome back. I hope you enjoyed that video and found it useful. Please remember to rewind, practice, repeat. And if you found it useful, please share it with your friends and family. See you in the next video.